Hi and welcome to part 2 of topic 4, market efficiency. So in terms of the readings, for this week we continue with chapter 16. However, in chapter 16 there's not much content about behavioral finance, so I would suggest reading chapter 10 from Till et al. 2013 as well. I uploaded a soft copy of chapter 10 in Till on Blackboard for your reference. So the learning objective for this topic is firstly to understand the different types of behavioral biases, to understand their implications for finance-related decision-making. So in this lecture, we focus mostly on the decision-making of investors, right? So of a financial investor who tries to buy shares or bonds, so on and so forth. We're not looking at the corporate decision-makers, for example, the CEO. Finally, we look at the relevance or the implications of behavioral finance to market efficiency. The outline of this lecture is as follows. Firstly, we introduce the concept of behavioral finance. We then look at the theoretical framework of behavioral finance versus the rational investor assumption, which is the utility theory. We discussed different types of common behavioral biases that could bias the investor's decision-making process. We then look at some examples of how different behavioral biases bias the investor's choices of assets. We then look at the link between behavioral finance and the efficient market hypothesis. So last week when we look at market efficiency, one of the important assumptions of the model is that investors are rational, meaning that if they have the same information, they will be able to analyze the information efficiently and they would be able to react correctly to the information. Yeah? So a lot of financial models assume investors are rational so that they prefer to maximize their wealth. So if we assume that all investors are rational, it helps to simplify financial model building, meaning that we can build economic models where individual investors behave in a predictable way. Right? So the rational investor in most of the finance models tries to maximize their wealth, and they are also able to process information efficiently. So they might have less information compared to a fully informed investor, but once they have the information, they will be able to react correctly to the information. Yeah? So the point of behavioral finance is to ask the question, are investors always rational? Do investors always react the same way if they have the same information? Yeah? So the rational investor assumption has been one of the most important and one of the most commonly used assumptions in financial modeling. So in most of the financial models, especially in asset pricing, we assume that investors are rational and they have homogeneous expectation, right? So if they are exposed to the same information, they would be reacting the same way, right? So in 1979, two researchers, Kahneman and Tversky, and they are not traditional economists, they are psychologists. They came up with this idea, and basically they argue that investors should not be expected to be rational all the time, right? So if they are given the same information, they might actually react differently depending on how the information is presented to them. So what these two people did was that they set up two experiments where they kind of had the same information, but they presented the information in a different way. And what they found was test participants actually responded differently to different ways that information is presented. Yeah? So the experiment that these researchers did was as follows. So they set up an experiment where the test subjects, the test participants, are exposed to two sets of options. In the first set of options, the test participants are given two choices. They could either choose gamble A, where there is a 33% chance of receiving 2,500, 66% chance of receiving 2,400, and 1% chance of receiving nothing. With the second option, gamble B, this is 100% probability of receiving 2,400. Right. So gamble B has no uncertainty, whereas gamble A has some level of uncertainty in it. So if we work out the expected well of the two options, we'll find that with gamble A, the expected well is 2,409, whereas for gamble B, the expected well is 2,400. Right. So this is just the weighted average outcome of the two options. Yeah? So if we are a rational investor, and if our goal is to maximize our wealth, then based on this information, we should be choosing gamble A. Kahneman and Tversky once again repeat the experiment, but they twisted information a little bit, so they still have the same test participants. Right? So with the second set of options, this is what we have. We also have two choices, gamble A star and gamble B star. With gamble A star, there is a 33% probability of receiving 2,500, same as before. However, in this case, we have 67% chance of receiving nothing. With gamble B star, we have a 34% chance of receiving 2,400, same as before. However, we have a 66% chance of receiving nothing. So if you compare gamble A and gamble A star, or gamble B and gamble B star, we will see that gamble A and gamble A star are similar, but gamble A star is shifted downwards by 66% chance of receiving nothing. Same as gamble B and gamble B star. They are similar, just that gamble B star has a 66% chance of receiving nothing. So it's a downward shift for both of the options. Yeah? When we work out the probability, the expected well of gambles A star and gamble B star, we find that with gamble A star, the expected well is 825. With gamble B star, the expected well is 816. So once again, if we are a rational investor, we would pick gamble A star because the expected well is higher than gamble B star. Right? Now, what did the two psychologists find? They actually found that for the first set of options, so when we look at this experiment here, people actually prefer gamble B, right? So people pick gamble B more than gamble A. In contrast, for the second set of options, people pick gamble A star, right? So this means that investors are inconsistent in their decision making, right? So if we are rational, we will be picking gamble A and gamble A star. So this experiment proved their point, right? So this experiment showed that investors might react differently if they are presented, if the same information is presented in a different way. Yeah. Similarly, we have another experiment where we have two sets of options, right? So in the first option, we start with we start with whatever we own. Say if our wealth is currently 1 million, right? We are given an additional $1,000, and now we are asked to choose to pick from either A or B. So in this case, we were deciding between having a sure gain of $500 or having a 50% chance of getting $1,000 and a 50% chance of getting nothing, right? So if we work out the expected value of these two options are the same. In the second set of questions, we once again start with, say, $1 million, which is our current net worth. We are then given $2,000, right? But we have to pick between these two options. So in the first option, we have to choose, we are going to make a loss, 100% chance that we're going to make a loss of $500. For option B, we have a 50% chance of losing $1,000, but 50% chance of losing nothing, right? So the researchers set up these two experiments and they asked the participants to decide which option they prefer in each of those set of options. Yeah. So if you compare the expected outcome of option 1 and option 2, you will see that the expected outcome for both these options are 1,500. Yeah. So both options would give the investor the same value, which is 1,500. However, what the psychologists found was that in the first option, when the investor is presented with this information, they pick option A, right? So they prefer a sure gain of $500. In the second case, when they are presented with this information, they don't pick option A, they pick option B, right? So Kahneman and Tversky then concluded that people reacted differently to gains and losses. Yeah. So with gains, people tend to be more risk-averse, whereas for losses, people tend to be more risk-seeking, right? So they choose the one with the uncertainty. So given the experiments that we saw before, it's very interesting to see that investors actually are not very rational, right? So they change their preferences when the information is presented in a different way. Now, interestingly, the experiments were conducted on a group of people, and among these people were business students with a statistics background, and some of them are physicians as well. So those people are those that are exposed to statistical training. But interestingly, their response was not different from other people. So they are still subject to some sort of biases, right, when they make decisions. So Kahneman and Tversky studied in 1979, therefore motivated a whole literature of behavioral finance, where people look at how rational the investors are, right? So behavioral finance is a set of study that concerned with the actual behavior and thinking of the individuals who make the financial decisions, right? So this literature recognizes that investors are not always rational, and given their irrationality, how would that affect share prices? Yeah. So market efficiency is always concerned with share prices, right? So how prices are determined in financial markets. The traditional view that we looked at last week states that investors should be reacting rationally, and prices only change when you have new information. Now with behavioral finance, it challenges that point of view, and it says that, hang on a minute, prices actually change without information if investors are irrational, right? So in the next few slides, we'll be talking about, we'll be introducing the theoretical framework of behavioral finance. So we first look at the theoretical predictions of a rational investor. We then move on to prospect theory, which is the foundation theory of behavioral finance. So in the next few slides, as we mentioned before, we will be looking at the investor's decision-making process, under the assumption of rationality versus the assumption of irrationality, right? So when investors are irrational, how would their decision be like versus the theoretical prediction of how they should behave when they are rational, right? So the rational model is explained in the expected utility theory, whereas the behavioral theory is the prospect theory. So in the face of uncertainty, when the investor is faced with uncertainty, this is what a rational investor is expected to do. So with the expected utility theory, we focus on the relation between investors' wealth and their utility, right? So the utility function, which is this curve over here, is a concave function, meaning that the utility of the investor increases at a diminishing rate, right? So at a very low level of wealth, so say we are standing here, W1. If we move from W1 to W star 1, our utility increases by this much, yeah? So from U1 to U star 1. However, if we are standing here, if we are already very wealthy, right? So if our investment has already been quite profitable, if we move by the same amount in terms of wealth from W2 to W star 2, the actual utility or the satisfaction of the increase in return is actually quite low compared to before, right? So it's still an increase, but it's a much smaller increase than before. So with rational investors, we hypothesize that they try to maximize the expected utility of their investment, not just the level of the wealth itself, right? Meaning that for an additional level of risk that investor has to bear, they expect to get a higher return to be able to get the same utility as before. So this is the base of risk aversion, right? So when we assume that investors are risk averse, this is what we mean, yeah? So for a very high level of wealth, if we ask the investor to bear an additional level of risk to earn an additional level of return, the return has to be much higher than before to compensate for the fact that the investor's utility is a diminishing function. Right. So with the utility theory, we assume that investors always maximize the expected utility of their wealth. But we assume that investors always behave the same way, doesn't matter if it's a gain or a loss, right? With prospect theory, again going back to Kahneman and Tversky 1979, we recognize that investors behave differently when they are faced with gains and losses, yeah? So in the experiment that we saw before, when investors are given gains, they tend to be risk averse. Whereas for losses, investors tend to be more risk seeking, yeah? So Kahneman and Tversky therefore hypothesize that investors' utility function should be different if we have gains and losses, yeah? So this is the modification of the utility function, value is utility, yeah, by Kahneman and Tversky in 1979. And this is basically the summary of the prospect theory, yeah? So if we look at the right hand side of the model, this is a concave function, which is not very clear to see, right? So when we have gains, investors are facing with a diminishing utility function same as before. So they require higher return for an additional level of risk, right? So what this graph shows is that when we have gains, investors are risk averse, as the expected utility theory states. However, when we have losses, the investors' utility function becomes convex, right? So investors are risk-seeking in the sense that the more wealth the investor has, the higher the expected utility from the gamble, right? So to sum up, in the prospect theory, the utility function is firstly defined on the deviations from the reference point. So if we have gains, we're looking at the right-hand side of the model, whereas if we are expecting losses, we're looking at the left-hand side of the model, right? So when we are stating on this region over here, we have a concave function, meaning that the utility function is increasing at a diminishing rate, right? So we are risk averse over here. However, when we are expecting to get losses, the utility function is a convex function, meaning that investors are risk-seeking, right? So this is consistent with the examples that we saw on the slide 6 and 7 before. When we frame the question as if the investors are making losses, they choose the option that is a bit more uncertain, right? Finally, we see that the slope, the utility function for losses is a bit steeper, meaning that investors are more sensitive to losses. Yeah. Okay. So we look at, in the previous slides, we look at the theoretical framework of behavioral finance compared to the rational investor expectation, right? So with the expected utility theory, we are describing the behavior of a rational investor. For a prospect theory, we are looking at the behavior of an investor when they are irrational, right? So they care for gains and losses in a different way. In the second part of the lecture, we look at different types of behavioral biases. So these biases are drawn from the psychology literature, where they look at how test participants react differently to the type of questions that are asked in the experiments, right? We first look at framing, right? So framing is one of the most common psychological biases. So this one says that if we frame the question differently, we will get a different response from the recipient, right? So in this example, what we have is we have two different types of cancer treatment. We either have radiation or we have surgery, right? And this is the success rate for different types of treatments, yeah? So in the first framing, we frame the information so that it's about the survival rate of the two treatments, right? So with surgery, we say that for out of 100 people that have surgery, 90 people live through the post-operative period, so 90 people survive. 68 out of that 90 people, they are alive at the end of the first year. And 34 people out of that 90 people, they are alive at the end of 5 years, right? So this is about the survival after a surgery. With the radiation, out of 100 people that have radiation, everyone lives through the treatment. 77 people are alive in the first year. However, only 22 people are alive at the end of 5 years, right? Alternatively, we have the same information, so we have the same statistics about these two types of treatment, but we can frame it a bit differently, right? So in this case, we will convey the information in that we talk about the mortality rate instead of the survival rate, right? So with the surgery, out of 100 people, 90 people live, so 10 people died during surgery. 68 people live by the end of the first year, so 32 people die, right, by the end of the first year. 34 people survive by the end of the 5th year. Therefore, 66 people die by the end of the 5 years, right? So the information here is the same as before, we just frame it in a different way. For radiation, we have the same information. So 100% survive during the treatment. So no one dies during the treatment, right? 23 people die by the end of the first year, and 78 people die by the end of the 5th year. So given that these two ways of framing the information still provide the same information, we would expect people to react, to choose the same response, right? Doesn't matter how the information is framed, but the results of the experiment show a different picture. Okay. So with the rational person response, given that we have the same information framed differently, but still the same information, people should still pick the same option regardless of how the information is framed, right? But the actual response that people found from doing that experiment is that in the first case, when we talk about survival rate, 18% people choose radiation compared to surgery, right? So with surgery, we have a higher survival rate for the 5-year horizon, right? However, when we frame the question by showing the mortality rates, then the response is a bit different, right? So in this case, 44% of people prefer radiation, yeah? That's because for the surgery method, we have a 10% chance of mortality, right, during the operation. Yeah? So this experiment once again shows that but people respond differently when they have when the information is presented differently, right? So when you think about advertisements, for example, this is a very typical way to manipulate the audience perception, right, in advertisements. So the second psychological bias that we look at is the endowment effect. So this effect is the tendency to maintain the status quo, right? So we have an example over here where we have one person who is on the way to watch an opera show, but he finds out that he lost his ticket of $100, right? So in this case, most likely for most people, we just go home and we forget about the show, right? We're not gonna go and spend another $100 to buy another ticket, right? So for this case, if we lose the ticket, we are not likely to buy another ticket, so that we're not likely to spend $200 in total, right, just to watch the opera. Now suppose that alternatively we don't lose the ticket, but on the way to watch the opera, we find that we lose $100, right? So we lose a $100 note. We drop it somewhere on the way. So most likely in the second situation, we will still go and watch the opera anyway, right? So that in total, to watch this opera, we are losing $200, right? So the wealth for the second option, where we lose $100 in notes, and we still go ahead and watch the opera show, is $200, which is the same as when we lose $100 and then we buy when we lose the ticket and we go ahead and we buy another pair of tickets, right? Another ticket to watch the show. So given that the two options has the same outcome, why is that we think the first option is not reasonable, but the second option is reasonable, right? With the second option, if we lose the $100 note, what we could do is we could sell the ticket and recover the $100, and therefore in total we are just losing $100, right? So why is that the case, that for the second option we are more willing to be out of the pocket for $200, whereas in the first option we are not willing to pay $200 to watch the opera, right? So the example here shows us that people tend to stay to their status quo, meaning that if they lose the $100 note, they will still go to watch the opera anyway, whereas they could behave in a more rational way and sell the tickets, so that they will minimize their losses, right? So they will just be losing $100. So the endowment effect is the bias to maintain the status quo. The implication of this effect on investment decisions is that people tend to hold on to the losses, right? So they don't want to sell losing shares. Okay. Even though when they sell the losing shares, they can cut losses. They can prevent the shares from making further losses. And also when you make losses, you have tax deductions, and you can use to offset other income taxes. Also, because of the endowment effect, because people don't want to sell losing stocks, this therefore cause the stock markets to underreact, especially to bad news, right? Because people don't want to sell the shares. And it exacerbates the momentum effects in stock prices. Yeah. Anchoring. So anchoring is when people make decisions based on the most recent information that they have, not based on the entire information that they have, right? So anchoring is when the decision maker places undue emphasis on some factor, on some number or measure, right? So for example, people, when they sell their houses, instead of looking at the fundamentals, they tend to be influenced by the purchase price of their houses, right? So in the next few slides, we'll be looking at some examples of how behavioral biases affect people's trading decisions in the financial markets. So most of the time we'll be focusing on the stock markets. The examples that we look at here are firstly myopia, or the tendency to focus on short-term profit or losses or uncertainty, right? So short-term information. Overreaction to news, investor overconfidence, and investor moods, right? Investor myopia. So as we mentioned before, this is the tendency of the investor to focus more on short-term news, short-term volatility, so on and so forth, right? So in 1995, two economists looked at the puzzle of why people invest more in bonds compared to stocks. Yeah. So what they find was that the long-term returns of stocks are much higher than bond yields. So it's about double bond yields, right? So for long-term investors, therefore, it would be more rational to invest in stocks, yeah, rather than bonds, because the long-term investment return of stocks is much higher. But the reality is a lot of money goes into bonds, but not stocks. Yeah. So what they did was they conducted a experiment where they showed the test participants different statistics in different times, right? So what they did was, firstly, they showed the test participants the overall average long-term returns of stocks and bonds. And they asked the participants to choose to either invest in stocks or bonds for their pension accounts, right? So pension investment tend to be for a more long-term horizon. So if they are given information for the returns, the average returns only, the test participants tend to pick stocks, right, because they have a high return. However, in the next experiment, the economists show the tested participants both the average returns of stocks and bonds as well as the short-term fluctuations of stock and bonds, right? So stocks tend to have a higher short-term fluctuations compared to bonds. However, for a long-term investment horizon, short-term fluctuations should not be that important, right? Because in the longer term, it's about the longer-term risk or volatility that is more important for these people, right? However, when they show the test participants the short-term fluctuations of bonds and stocks, the test participants change their preference, right? So now they prefer bonds. Okay. So the question here is, maybe the evidence of both shows that investors are risk averse and therefore they worry about the riskiness of share investment, right? Even though we mentioned before that short-term fluctuations might not reflect the long-term fluctuations of the two investments anyway. So to answer this question, Siegel in 1994, they actually look at the long-term volatility of stock returns and bond returns, and they find that actually for the long run, the volatility of stock return is much smaller than the long-run volatility of bond returns, right? Meaning that investors don't really estimate, don't really value long-term volatility too much. They rather value or they care more about short-term fluctuations, right? Even though they have a long-term investment horizon. So this evidence shows that investors focus more on short-term, right? They focus more on short-term information. Okay. So these two findings therefore show that investors put more weight on short-term information, even though they have long-term investment horizons, right? Overreaction. So we kind of talked a little bit about overreaction last week when we introduced different types of testing methods for the market efficiency hypothesis, right? So we will talk a bit more on overreaction in this topic. So over the past few decades, people have found that investors tend to overreact to the most recent news, and this is consistent with investor myopia, right? So the more recent news carries more weight than the not so recent news, right? So an example of this tendency is that Robert Schindler, he finds that before a crash, the investors' expectation for a crash happening was about 14%. However, right after the crash, investors' expectation for the next crash increased to about 40-something%, right? So investors changed their expectation based on their most recent experience, right? People also find that investors tend to overreact to dramatic upgrade recommendation by inexperienced analysts, but underreact to less dramatic upgrade recommendation by experienced analysts. So the experience of the analysts here is not as important as the magnitude of the recommendation, right? So somehow investors fail to recognize, fails to tell how accurate the recommendation might be, but they tend to be more focused on the size of the recommendation. Return reversal. So last week we talked about momentum and return reversal. So return reversal is when you have the momentum effect reversing after a few years, right? So from 3 to 5 years. So return reversal shows that the market actually overreacts or underreacts before, and now it reverses to the fair price level, right? So if there is return reversal, it means that investors overreact or underreact before, right? Overconfidence. So how does this behavioral bias affect investors' trading behavior, right? So overconfidence relates to the ability of the investor to beat the market, right? So investors only trade frequently if they believe that they can beat the market. Yeah. So the more confident the investor is, the more likely that they will be aggressive in the market. Yeah. So people find that trading activity, consistent with what we mentioned before, people find that trading activity or trading volume or how frequent the investor trades relate to how confident they are in their ability, right? So how do we tell if the investor is trading more frequently? Because they have superior ability, they actually have better ability compared to the market, or is that just because they are overconfident, right? So if the investor has superior ability and because of that they trade more frequently, they are more aggressive, then we should be able to see that for more aggressive traders, they should earn higher profits compared to the market portfolio, right? Whereas if more frequent trading is just a trade of overconfidence, then we should see those trading to not be profitable, right? To underperform compared to the market portfolio. So in the literature, people test the profitability of aggressive trading activities and compare the profit of those trading activities with the buy and hold strategies, right? So buy and hold strategy is when you invest in the market portfolio and you hold that for a long time, right? So buy and hold strategies are more passive or market portfolio kind of investment strategy, right? So the idea is that the returns of aggressive trading strategies would tell whether the investors have abnormal ability or whether they are just overconfident, right? So in these studies, I think this is in the 1990s, what they found was that actually for the more frequently traded portfolios, these portfolios actually underperform compared to the market, right? Over a 1 year horizon. Right. So the more frequent the trader trades, the worse he performs compared to the market. Also, in another study, and in this study, people actually tracked down individual investors' accounts, right? So what they found was that amateur traders tend to underperform the market, and the more active they are, the more underperform their portfolio is, right? People who actually don't trade too much, they actually perform quite well. This is the after transaction cost basis, right? Also, for professional stock investors, if they outperform the market in the recent past, they tend to be more overconfident which is indicated by their level of trading, right? So they become more frequent traders, and subsequently they underperform the market. Investor moods. So a few finance studies also look at how investor moods affect their trading activity, right? So for example, people found that during cloudy days, the returns in the stock market tend to be quite small compared to sunny days. Yeah, so people tend to be happier during sunny days, and they therefore tend to perform a little bit better. Also, in another study, people find that so this study is conducted in the Europe, right? So what happened was that this study looked at the stock returns following the World Cup, right? So for countries where soccer is a big sport, the returns on the stock markets actually react to the performance of the national team during the World Cup, right? So if the national team, say the Brazilian team, they got eliminated from the World Cup, then the stock market on that day or a few days afterwards tend to underperform, right? So people tend to make losses after those days. Other studies sort of replicated the soccer study, and they find that for other sports too, the stock markets tend to be quite bad after a loss in a certain sport, right? On the other hand, for wins, right, so these previous studies look at losses, but for spot wins, we don't see a reaction in the stock market, right? So people tend to react differently to good news and bad news, yeah? So in the previous few slides, we introduced the concept of behavioral finance, and we talk about how different psychological biases affect investors' trading activities in the market, right? So in terms of the efficient market hypothesis, how is behavioral finance reflected in the efficient market hypothesis, right? So would irrational reactions by investors make the market inefficient, right? What are the conditions under which investors' irrationality affect market prices, right? So suppose that we have some irrational investors in the market, and these are the people that make market prices to deviate from the equilibrium price, right? So equilibrium price is here. People overreact and it shoots price up. People underreact, it shoots price down, right? So the question here is, given behavioral biases, would we expect the market to move up to a new equilibrium just because of investors' irrationality? Or do we expect the market price to move down, to adjust itself after a while, right? So the argument here is that investors can be irrational, yes. However, the irrationality of the investors would only be affecting the market prices over time, over a long run, if other investors don't arbitrage, right? So if we have two investors in the market, for example, investor A being a hedge fund, and this investor is very rational. Investor B being an individual investor, this investor is subject to behavioral biases, right? So investor B's trading might move the market prices out of equilibrium, which is what we saw over here. However, if investor A is allowed to do arbitrage, what they would do is that they would trade accordingly when they see a mispricing, and because of their trading activity, the market price should move down or should adjust back to the equilibrium, right? So the implication here is, therefore, we can have irrational investors in the market for sure. However, if we have rational investors, also in the market and they are free to do arbitrage, then market prices would not deviate from the equilibrium for very long, right? So overall, on average, the market will still be efficient even though we have irrational investors, right? Provided that we have arbitrages also. Okay. However, when we have irrational investors and when we have limits to arbitrage, so that this rational investor over here, they can't trade, they can't take advantage of the mispricing, then in this case, the irrationality of the investors would affect the equilibrium price, right? So it might move the share prices up to an irrational level and it stays there for a long time, right? So what do we mean by limits to arbitrage? Yeah. So limits to arbitrage are situations where the rational investor are prevented from fully capitalizing on the arbitrage opportunity. Right. For example, we might have 10,000 investors in the market and the mispricing is worth, say, $1 million, right? A hedge fund, we have 9,9999 irrational investors and we only have one hedge fund in the market. Yeah. So the hedge funds, they could identify the mispricing of opportunity for sure, but because they are capital constrained, right? So they only have limited amount of funds to invest, they can't fully capitalize on the arbitrage opportunity, and therefore the market price would stay at the irrational level, right, for a long time. Okay. We also have legal restrictions. For example, some sophisticated investors like pension funds or insurance funds, they have restrictions on what kind of assets they can invest in. For example, for insurance firms, they can't buy bonds that is below investment grade, right? So if there is a mispricing in those riskier bonds, they can't take advantage of that. Okay. So the implications here are therefore, without any limits to arbitrage, behavioral biases would be random, right? So people behave irrationally, but in a random fashion. And whenever you have an irrational trading, arbitrageurs would come in and they would exploit the mispricing and they would make the mispricing disappear, right? So in the short term, behavioral biases might affect share prices, but overall in the long run, share prices will always stay at equilibrium if we have arbitrageurs, right? Or if we don't have any limits to arbitrage. Only when we have irrational investors and at the same time we have limits to arbitrage, then behavioral biases can influence stock prices in the long run, right? So the implication therefore here is that the presence of behavioral finance or behavioral biases in financial trading by itself does not mean that the market is not efficient. Yeah. The presence of behavioral biases together with limits to arbitrage would make the market inefficient, right? So you need to have two conditions for the market to be inefficient. One is investors being irrational. The other one is that there are limits to arbitrage, right? So this concludes the second part of market efficiency.